Well, I just wanted to say that the overall generalization from a statistical analysis is great, but it hides the real market. And I respect all my colleagues on the research side, and they can only do their analysis on published data, which we know in Germany is not as visible as it is here in the UK and indeed the US. I would disagree in the sense where you see the value in the marketplaces and when you see international investors. Having come recently to KGAL from a previous house who was a very significant pan-German investor, I see a lot of internationals in the secondary markets, in the Mannheims, in the Erfurts, in the Kassels. Why? Because there is value, there isn't volatility, there's rental increase, rental growth, which doesn't have the same possibly dynamics as Frankfurt or Hamburg, but it has sustainability. So first and foremost, I would disagree that there isn't interest or appetite, and I have put enough investors into those marketplaces successfully. So that's the first point I'll say. Second point is that the alternative real estate sectors in Germany are growing significantly. We didn't touch upon them in the presentation, but if you see the allocation now to healthcare, see the allocation to student accommodation, we need to look at that. And possibly the most important thing for me is the competition the capital is having in the marketplace. The returns means that the CIOs are now looking at other alternative sectors. Clearly with my flag of KGAL as a real asset manager, I'm seeing houses comparing the return in real estate compared to infrastructure, compared to, in my case, aviation as well. And where the returns differ, they're reallocating capital. So from a real estate perspective, our competition isn't each other, it's also the other asset classes in the alternative sector.
Okay, interesting. Michael, yeah.
Yeah, just to back up what Doug was saying there, we have a sort of key strategy in Germany for a non-German investor, and that is in the secondary, tertiary cities. It's small lot sizes, keeping below the radar of certainly a lot of international investors, but also local investors. We do pick up competition from privates, but hopefully with certainty of money, speed of execution, that gives us a little bit of sort of competitive advantage and a track record of doing that. So we're actually not looking at the major cities at all, we're just focusing on these smaller cities.
The question is, you already have $10 to every dollar of real estate, so it doesn't matter if there's 20, it's only a matter of pricing at the end of the day, and how much will the broker squeeze out of the two guys running head-to-head at the end. So at the end of the day, it doesn't matter if there's 20 guys there or 10. The lack of product will create competition, even if there's only 3 or 4 of them there. So even if more people come in, and I can't agree more, B locations now, they're standard institutional products. Everybody knows these markets. Germany is extremely transparent. What you don't see on the research side is who's actually investing the capital. What you have is a UK address or a US address or a German address investing for different sources of international capital in those markets. So it's spread out all over the place. And if anything, I can convince people to stay away from Germany today. It'd be fantastic. I hear Hungary is really booming right now, and Bulgaria is up on the trend. And Ukraine is probably not a bad place to go. No, it is just way too much. And the difficulty we have is, I mean, the numbers that I've seen here, and I don't think it's going to be a huge investment year. A, we're coming off a top year anyway, and B, there is no product out there. It is extremely difficult to invest. And, my fund manager will always challenge us to say, it's easy just to pay top dollar, but is that actually giving you any value back for our investors? And we're capable of doing that, but there's certain limits. And we're coming to a point in Germany, it's just a reflection of that. Of course, the 30% that used to go into the UK is going to go somewhere else, and it's going to go into the next safety flight area, and that's going to be Germany in all sectors. And everything that has a brick somewhere involved in it, it will attract investors. There's going to be misallocation, there's going to be overpricing, there's going to be the whole shebang of what happens in real estate, simply due to the fact that the supply side isn't going through, the fundamentals are strong, and that's okay. But you're starting to lose, I don't get some of the pricing anymore. I simply don't understand it. And maybe our valuers won't understand it either. But I understand the continuous flow. The continuous flow will move on. It'll go into every nook and cranny. It's like water. It'll just push into whatever is available, and it will probably make some mistakes, and then it'll correct again. But that's the point of the market where it is. And if you want to invest in Germany, get used to some unbelievable pricing and massive competition in any sector. Funnily enough, now I'll stop. Because if you don't stop me, you know this, I'll just keep going. There is still product out there that doesn't sell, which I find amazing yet again, and I think that's what you need to look at. where are the opportunities? Where is the stuff that some people aren't buying? Is it only mismatch in pricing? Or is it indeed a quality? Is it a risk? Is everybody pricing through the risks? There are targets out there that don't sell. And that's the real thing to discuss, is why does that happen? Where's that mismatch coming from? Especially with that increased capital flow coming in from the UK.